I'm Stephen Herwire, owner of Herwire Financial Plans with Direction. Today, after the market wrap, we're going to talk about how to optimize your Social Security benefits. Social Security retirement benefits are a vital component of retirement income for many people. It consists of multiple benefits, including disability, survivor, and retirement benefits, and is an indispensable part of many individuals' financial plans. Knowing how to optimize your benefits can be advantageous as you work towards a confident retirement. Deciding when to start receiving Social Security benefits is essential. There are three options: early retirement, full retirement age, or delaying benefits. Each offers a different perspective depending on individual circumstances, making it vital to understand each option thoroughly. Keep in mind when I say there are three options, I don't mean you have to file at 62, full retirement age, or age 70. You can file for benefits to begin any month during that 8-year period. Every month you wait until you turn age 70, your benefits will increase. Early retirement. Opting for early retirement benefits involves starting to collect benefits at 62. Doing so provides immediate income but results in a managed monthly benefit. This reduction could range from 25 to 30% depending on when your full retirement age, defined by Social Security Administration based on your birth year. While this option may be appropriate for those who need immediate income or have a shorter life expectancy, it might not be the most optimal strategy for those who live long lives. To make an appropriate decision, assess your financial needs, health status, and family longevity history. Full retirement age. When you get to this age, you get 100% of your Social Security retirement benefits. If you anticipate a longer lifespan and can manage without the extra income for a few years, you may benefit from waiting until full retirement age. It also enables more significant spousal benefits and allows room for continued income and benefit growth from staying employed for a more extended period. Delaying benefits. An alternative strategy is to wait past full retirement age, which allows benefits to grow by a certain percentage until age 70. They increase approximately 8% annually depending on your birth year. Individuals who postpone drawing their benefits beyond full retirement age earn credits, yielding a higher lifetime income for retirees living well into their late 80s and beyond. This strategy may be appropriate for those with prospects of good health and financial independence during their later years. There's a few other considerations to worry about: birth year, taxes, earnings test. Let's talk about those. The day you were born determines your full retirement age. You were born on January 2nd, 1960 or after. Your full retirement age is 67. If you're born on January 1st or earlier, your full retirement age will be something less than 67. Now, keep in mind, Social Security focuses on the day before your birthday because it's the end of that year of life. So that means anybody born on January 1st is considered to be born the previous year for Social Security purposes. So if you're born in 59, full retirement age, 66 years and 10 months. 58, 66 years and 8 months. 57, 66 years and 6 months. 56, 66 years and 4 months. 55, 66 years and 2 months. If you're born before 55, your full retirement age is either going to be 66 or 65. Taxes. Another vital factor to consider when optimizing your benefits is taxes. Suppose you continue to earn additional income, including wages, self-employment, interest, dividends, and other taxable income reported on a tax return, besides Social Security benefits. Your Social Security might be partially taxed. Therefore, adequate income and tax planning may help manage this potential disadvantage. Your tax filing status will help determine how much of your Social Security is taxable. If you're married, filing jointly, if your provisional income is less than $32,000, if you're single, less than $25,000, none of it's taxable. If you're married, filing jointly, and your provisional income is between $32,000 and $44,000, for singles, it's $25,000 to $34,000. Up to half of it is taxable. And if you're over $44,000 and married, $34,000 and single, up to 85% is taxable. Now, some people saying, Steve, what's provisional income? It's calculated by adding your adjusted gross income, not including your Social Security benefits, Any tax-free interest, which means if you've got interest coming off a municipal bond or municipal bond fund, that counts toward it. And then you add on half your Social Security benefits. That determines what your provisional income is. It's one of the reasons I like folks to have Roth accounts, because distributions from Roth accounts have zero effect on provisional income. Earnings test. One commonly believed fallacy is that once you start collecting Social Security, you cannot work. As the earnings test illustrates, this is incorrect. So if you're collecting Social Security and you're older than full retirement age, not counting the year you hit full retirement age, the earnings test does not apply. The year you reach full retirement age, you can earn up to $62,160 and not be subject to the earnings test. If it is the year before, any year before you hit full retirement age, you can earn up to $23,400 and not be subject to an earnings test. By the way, these are 2025 numbers. They'll change every year. But if you earn more than these amounts, your Social Security earnings will be reduced. There's other ways you can boost your Social Security retirement benefits. You can remain in the workforce, work for 35 years or more. Basically, it takes your top 35 years of earnings and uses that to calculate your benefit. You can delay benefits. You can, one really important thing is monitor your Social Security statement for errors. You can collect spousal benefits, and you can put a temporary halt on your benefits. Things to consider when deciding when to collect Social Security. If you're married, careful consideration is important, because when the person with the best earnings record is going to file for benefits, especially if they're male, you need to keep a few things in mind. Generally speaking, women outlive men. Also, men generally have better earnings records. This is not a hard and fast rule, it's just the numbers. So when a couple has made it into retirement and they're both collecting Social Security checks, if one of them dies, no matter which one, the smaller Social Security check will disappear with them. So if you're the person with a shorter lifespan and you're the person with the better earnings records, you are likely picking for your spouse. If you're collecting Social Security at age 65, it's likely they will try to sign you up for Medicare Parts A and B. If you do not want this because you're covered by an employer or a retiree plan, you may need to actively stop them. If you're covered by an employer plan and contributing to a health savings account, not a flexible spending account, care should be exercised even when signing up for Part A. There are a few things, I'm not going to get into them here. If the person with the best earning record goes in to see the doctor early in their eligibility for Social Security and gets an unfortunate diagnosis, then you should exercise care when deciding whether to file, especially if your spouse has a poor earnings record. When filing, if the person with best earning record files early and then passes away, it may have a deleterious effect on the spousal benefit. If you're divorced or widowed, keep in mind you can sometimes file under your former spouse's earning record. If you're divorced after having been married for 10 years, it's possible to file based on your spouse's earnings, and don't worry about an angry call from them because they won't even know it. It has no effect on their benefit. Financial advisors will think a lot of things you won't. A good one will have up-to-date knowledge on ongoing law changes. They will often have access to tools the average consumer does not have. Their focus is on this area, causing them to think beyond a surface level. Also, many have years of experience, meaning there's a chance they've seen your situation or one similar to it before. Because Social Security claiming decisions can mean a difference of tens of thousands of dollars for a family, having a good financial plan will help optimize this choice. And here's a few sources. If you didn't get them, contact me, I'll send them to you. When you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that are tailored to each individual situation. Working years. Am I saving enough and is it in the right place? Glide path to retirement. 10 years before retirement, will the USS retirement be shipshape on the appointed day? Once you're in retirement, how do I avoid running out of money before I run out of life? And finally, your legacy. Does what I worked hard for get to where I wanted it to after I'm finished with retirement? I can be reached at herwirefinancial.com. I do in-person Zoom and phone appointments. I am licensed and registered across several states and can easily add states if there's a need. If you want to schedule an appointment, you can click on the schedule an appointment button in the upper right-hand corner of my website. If you want to see more videos like this, go to my YouTube channel. Click on that red button. You'll go there. Please let your friends know to like and follow me on Facebook, LinkedIn, Twitter, and like and subscribe to my YouTube channel. For those who prefer the good old-fashioned telephone, 518-631-2569. Do not text that number. You will be sad. I will be sad because I won't get it. Opinions voiced in this material for general information only, not intended to provide specific advice or recommendation for any individual. All performance reference is historical. No guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax, legal, ERISA, or investment advice. Consult your advisor prior to taking action. Unmanaged index returns do not reflect fees, expenses, or sales charge. Index performance is not indicative of the performance of any investment. Investing in stock includes numerous specific risks, including the fluctuation dividend, loss of principal, and potential illiquidity of the investment in a falling market. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions, and it may not achieve its investment objective. The Dow Jones Industrial Average is comprised of 30 stocks that are major factors in their industries and widely held by individuals and institutional investors. Standard & Poor's 500 index is a cap-weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. NASDAQ Composite Index measures NASDAQ domestic and non-US based common stocks listed on the NASDAQ stock market. The market value, last sale price of the multiplied by total shares outstanding, is calculated throughout the trading day and is related to the total market value of the index. Thanks and have a great weekend, everybody.